All right, Tucker, it's all about the myths that we need to dispel. So, we're going to talk about three common myths that are keeping people from moving forward in it with an opportunity to lock in the home that they're looking for that will help them grow their wealth. So, the first myth today is you need 20% down. Let's talk about that.
Yeah, so definitely a myth, and this is a myth that we dispelled last week on our podcast. But there's a lot of great programs out there that allow buyers to get in with really little out of pocket. FHA at 3.5%, conventional programs with 3% down. And I think the key component with this myth is I think a lot of people expand on the myth that you need 20% because private mortgage insurance is so costly. And I think that's even a bigger myth, that private mortgage insurance really isn't that expensive today. It's risk based, it's based on your credit profile, and it really makes sense to buy before you have saved up 20%. Now that mortgage insurance is
So
much
that's
less.
really where this came into play. Is a lot of people were talking about the PMI and it's gonna it's gonna be an extra payment on top of your mortgage principal and interest. You've got PMI, and then you have property and casualty insurance, and it just starts to stack up. So you say it's rate based. What does that look like? What are the general costs on the low end and high end? Is it a percentage?
Yeah, so it's going to be based on the risk profile of the borrower. So a 15% down payment is going to pay less in mortgage insurance than a 5% down, because the buyer has more skin in the game with the higher down payment. Um, but looking back at your prior slides about the average price, I think that's the bigger question. Is we have a moving target with a big number on price. How long is it going to take somebody to save 20%? And if the price continues to move up, they may never get there. So I think oftentimes we just need to get in where we can with the down payment that we have available, bite the bullet on mortgage insurance, and then work to get to that 20% mark to remove the mortgage insurance when we can.
Yeah. So is mortgage insurance, is there an ability to have that be paid in a lump sum rather than a monthly payment?
Absolutely. Yeah, there's a lot of flexibility with it. You can do upfront, so you pay it all at the time of closing. You can do monthly, or you can do split, where you combine a little bit upfront with monthly to try to arrive at the monthly payment and the cash to close out of pocket that you're trying to achieve.
Right. So it's kind of thinking that if you maybe if you have some seller credits can help pay some of that, right? So if you
Absolutely.
have a big chunk of seller credit, you can kind of go, all right, let's use this wisely. So okay, we'll come back to that. I
Yeah,
might
one
have.
other thing I'll add there too. Oftentimes people think that the best interest rate is tied to a 20% or greater down payment. And contrary to that myth, interest rates might actually be better at 15% with mortgage insurance than you would receive at 20%. And
Oh,
that is
interesting.
because of that insurance policy. We have a second party that shares in the risk of default, meaning we can potentially offer a little bit better of an interest rate on that risk.
Oh, that's cool. So you're just tweaking it a little bit. Yeah,
Yeah.
one of the things I was thinking about is whether you did a monthly or you did the prepaid is, interest rates aren't ideal right now. They're not horrible, but they're not ideal. But let's say 2 years down the road, two things will happen. You may end up 80% loan to value because of the appreciation. And two, that then if you refinance, now you're getting lower rates, and that's going to drop off the PMI. So from a cash flow perspective, if you can swing the PMI on a monthly basis, and then in say 18 months or maybe 2 years, interest rates are lower, your things higher. Now you only paid, you didn't have to pay a higher premium. So just kind of strategizing through how to get the most out of your money. I think that's a great way to do. Myth number two. So your pre-approval rate is the rate you'll get when you close. That's interesting.
Yeah, we get this question a lot, and I think the bigger myth is, or question is, just when do you lock an interest rate? Like at what point in the process is the interest rate guaranteed? And what I always try to tell people is that it's tied to an address. So we need to have a property identified before we lock in an interest rate, and that isn't always the case. But I would say in 99% of the scenarios, once the buyer has a property under contract, that's at which point they're monitoring rates and they're deciding if they should lock or float. Until you have identified a property and the seller's accepted your offer, you're floating the rate. We're just monitoring it. We're seeing if it's going up or down. We're keeping you in tune with where it is, but we're not actually locking in until you're under contract. There are a few ways around that. We do, as an industry, offer some solutions where you can lock and shop.
Right.
In a scenario where we anticipate that rates are going to move up and continue to move up, there could be a scenario where it would make sense to do a lock and shop type program, but that's going to typically require an upfront fee. And so as a lender, we have to coach a client on, do we lock that in, or do we kind of gamble and wait for rates to come down? And so it depends on the movement of rates and where we anticipate them going.
Okay. All right. So then our last myth is you should wait to buy a home until prices are lower, coming down. Yeah.
Yeah, so I'll leave it to you on home prices. I don't really ever see a scenario where home prices come down. And if they do, I don't really want to know why they did. But when rates come down, I think in our market specifically, we need to be mindful of the inventory that you showed on your prior slides. Is as rates come down, more buyers will enter the market, creating more multiple offer situations and increased prices. And so you may do yourself a disservice by waiting for the perfect rate, because the home prices will reflect that it's the right time to buy.
I kind of have a little bit of a theory that one way for things to change is for salaries to increase. And, in our market, number one, we need inventory to increase. But number two, inflation is good for paying off our debt as a country, because we can pay it off faster because of inflation. I'm not saying that I want to keep inflation that way, but I also don't want the debt either. I don't want that handed off to our kids. But one interesting point may be that actually salaries increase exponentially in order to create a change in affordability faster than interest rates coming down. I'm seeing a lot of people now just going ahead and moving forward with their buying decision because they feel like I have to do something anyways, and so we're just getting creative with how to help the cash flow situation. So my advice is, if you're in a season of your life where it makes sense to put down roots, maybe it's your first home, or get a bigger house, a smaller home, let's talk. So awesome. Thank you for those myth-defying questions, Tucker. Okay, we're going to take another short break, and then we're going to bring in Kevin Singleton of Elevate USA. It's a local charity looking to launch here in the greater Seattle area. I think you guys will find a great conversation here. So come back after this short, I'm looking for it, commercial break.